Mike, you and the team have put out a hefty body of research on electric vehicles, with the most recent installment being the Global Battery Electric Vehicle Deep Dive that was out this week. From the surveys you've conducted and the analysis that you've carried out, are the challenges in BEV adoption getting any better?
Hi, Rod. Yes, that's a good question. So one of the key conclusions in the report is that ICE, so internal combustion engine vehicles, which includes hybrids, will dominate industry profitability out to 2030. And while this was a bold assumption 12 months ago, it's now the reality given BEV demand is stalling. And with our BI buyers survey indicating consumer apathy beyond first adopters, given the high price of BEVs, range anxiety, and a lack of public charging infrastructure, there's going to be issues about the ongoing take-up of battery electric vehicles. The exception is China, where the market is growing, but this is driven by fierce and unsustainable price competition.
And Mike, Tesla continued its pattern of gross margin erosion when it reported results this week. Is there a case to be made that there's too many OEMs and suppliers chasing ever-decreasing economics, which may force a wave of consolidation?
Yeah, it's a good point. So, as per the title of the report, it's going to be survival of the fittest for BEV pure plays that have lost over 660 billion euros of market cap over the past 2 years. So unless you have the economies of scale, such as with BYD and Tesla, you're going to find it very difficult to survive as lower pricing drives down prices, residual values and profits. And that contrasts with legacy automakers who will continue to enjoy strong profitability from their ICE portfolio, providing excess cash that can be returned to shareholders or reinvested in new tech. What this means is that many pure plays will follow the likes of Fisker and go bankrupt unless they have industry-leading tech that is attractive to legacy brands, such as the case with Volkswagen investing in XPeng and Rivian, and Stellantis investing in Leap Motors.
And then the final thing is, what are some of the critical milestones our listeners should be keeping an eye out for?
Yeah, expect more strategic updates, adjustment to BEV targets, such as we had in the past couple of weeks. So GM have said that it won't hit 1 million BEV sales by 2025, and it's delaying the opening of a pure EV plant in Detroit. Porsche have just said that they're going to pull back from their 80% BEV target by the end of the decade. It's now letting the consumer decide. It's relying on powertrain production flexibility to navigate this. And then on a monthly basis, it will be the developing BEV sales mix that we see regionally, and pricing will be key, with significant premiums that are being paid for BEVs and PHEVs in Europe, holding back the demand for these vehicles, but they also cap losses for legacy automakers. The situation is different, as I said, in China, where BEVs are being priced at the same price as an ICE, and in many cases are cheaper. And as I mentioned, this is an unsustainable business environment for those companies.
Mike, again, thanks very much for your time. There is so much out of that deep dive report that's worth delving into. Hopefully our listeners do. A spot to watch. Appreciate it. Thanks very much, Mike.